Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive in. Let's take a look and see what people are sharing. If you want to follow me at finding_finance, and if you want to join our community, findinghealthandvalue.com, where I go over whatever you guys want. I answer your questions. It can be precious metals related, commodity related stuff. It can be non commodity related stuff. I've got question and answer sessions on the weekends where you can interact with me directly through a Zoom call. And we've got midweek updates that I do where I share my opinions on individual companies and the companies that I am personally buying and think are very good setups. So I go over all the sectors that look that I watch, whether they're good or bad. I will let you know what I think of them. Mayday coupon code is a discount if you are interested. So we're going to start with Lamont. I can't pronounce that last name. Grolke. My wife said she wants a G Wagon. How do I respond to this? Well, I can respond back to you and say, you've lost, bro. You've lost. You have not won. You're in a tough situation. Depends how you got in the relationship. If you were a person that were flashing money in front of someone's face, then you might be in trouble. Um, right now, the situation I am in is my wife doesn't necessarily want a G Wagon. She just wants a working car. We drive old cars. We've got three older vehicles that we drive on a daily basis because Colorado tears them up. The only thing I'll say is I am your local mechanic here, fixing them and keeping them on the road with uh, limited lifetime warranty parts from AutoZone or wherever else. That's what I'm doing. I don't know if that's worth it or not, but that's what I've been doing. Wasteland Capital, JP Morgan 3 days ago says that stocks won't do much for the next decade. JP Morgan today, expect a face-ripping 15% rally from here. Okay, then. So, guess what you cannot use? You cannot use the news and read about stocks. It doesn't get you anywhere. Trust me, guys, I've learned that from a while back. So, everything that I've done to create the three pillars, those are the three things that are absolutely necessary and critical in order to get early entry points to make a lot of money. The three are ratios, technical analysis, and market conditions. Market conditions deals with cycles, where we look at different cycles and different lengths of cycles. The ratios tell us the sector value compared to history, and technical analysis brings all of this news and garbage out of it and looks to see if we can see evidence of the cycle turning in the technicals, which is more or less charting the psychology of the herd. And that is all you need. Now, if you don't know those three very well, sign up to the website, ask me about them, learn. When you learn, you will, if you learn just a fraction of it, what you then know, at least at a minimum, is you know that there's certain things to look for. It will get you in the ballpark of bottoms. It will get you in the ballpark of tops. No one can precisely call a top. No one can precisely call a bottom. I can get you damn close. Can't get you perfect. I can get you close. And it does require patience, and it does require a little bit of emotional control to take all of this information and create a, I'll call it a life-changing investments over a decade or 5 years or 3 years or whatever it takes to play out. Peter Schiff says, if you thought inflation was bad when the Fed was raising interest rates, wait until you see how much worse it gets now that the Fed is lowering them again. Now, a lot of people are talking about the potential recession that we're going to get because the Fed is lowering interest rates. And that is where I don't know if they are correct. I think a lot, and I think a lot about the conditions. That is where you win or lose, is getting the market conditions correct. That is where it all lies, especially if you are a trader. Because if you're trying to do things in the short term, you have to get the market conditions right to consistently outperform something. The reason I think that it's a culmination of a bunch of information put together. We raised interest rates because I think there's a component of stimulus that was in that. It wasn't an organically driven interest rate. The interest rate didn't organically move to the markets, creating that inflation. It was a stimulus synthetic injected into the system. And I think that rates probably went too high too fast. So they're backing off rates. And I think what we'll see is the economy strengthen again. What is argued is, what does the transition between that look like? And I don't exactly know that. No one does. What the transition between tightening a little bit too much to loosening, and what that transition looks like. Is it a hard landing, soft landing, et cetera, et cetera? We don't know. But there are some key metrics that we can look at to gauge if we're strengthening or not. And that is the key to getting the market conditions right, is what do you look at? I think the Fed thinks that they can pull it off, and maybe they can. Maybe they can't. Everyone will say in history they couldn't pull it off. I will disagree with them because I don't think that the conditions are exactly the same as they were historically. They raised rates, which is basically the market raising rates, but that was all organically driven by the real estate cycle. This time around that we went through was synthetic plus organic. It's a different equation. And that's where people are off sides because they don't think, they just look at charts, they just look at the 2 and 10 yield curve, and then they automatically draw conclusions like it's the same beforehand. What I do is I look at the conditions that are driving the yield curve to figure out, is it exactly the same or not? And with that synthetic stimulus thrown into the system, it's muddying the waters, is what I'll say. We could still get a slowdown, but a lot of those slowdowns were driven by the real estate cycle, and this is not being driven by the real estate cycle. It isn't. So it could be similar to 2000 to 2001. It may be completely different than that even. I've got here the agribusiness ETF mood. It looks great, and we've got kind of a longer term chart here of a breakout and then a retest, and we're starting to move on up. If we were going into a recession, why is this breaking to the upside? Wouldn't this be breaking lower? Now we are seeing some sectors that look like garbage, that are really low. They've pulled back quite a bit. Rare earth metals, lithium, they've gone some pretty big pullbacks there. This here looks like a pretty good setup, and there's a bunch of other sectors that have good setups. If we were going into this blowout recession, we wouldn't be seeing these setups like this, in my opinion. Oil doing a false breakdown question mark, or is it just doing a retest from the bottom, which means we could roll back over and go lower? What do you think? I say that it looks strong to me, and this is what I'm talking about. We've got this trend line here. We've come on down, and you could redraw this trend line. You could draw it sideways where this is more the bottom here. Now we're coming back up. Now we've got a bullish engulfing here. Is this that's generally a strong move higher with the bullish engulfing? Obviously, we're early. I'm not stating that we're breaking up, breaking to the upside. We got to wait and see. But is this going to break to the upside and back within the pattern, or are we going to roll over here? That's what we're looking for. That's the ultimate thing we're looking. A financial guy or finance guy says, research shows the S&P 500 drops an average of 20% in the months following the first rate cuts of a cycle. That's what everybody's referring to. That's why everybody is bearish and calling for a move lower. What I'm saying is, a lot of those markets were organically driven. We went through a stimulus slash partially organic driven market where the credit and the inflation that came into the system from that credit expansion, a lot of it was synthetic. So if he if he slowed down the organic economic growth and let the synthetic stimulus kind of run out to some degree, when he lowers rates, Powell, we could reignite the economic portion of it if we're in the middle of an expansion phase, which I think we are. That is something that I don't know because we don't. None of these previous cycles have the same roots of the movement of inflation. They're all different. So you can't look at history and say that this is a carbon copy of a situation of the same conditions that we've got, the same inputs to this equation. And that's what makes it difficult. We don't know what it's going to necessarily do because we can't look back at history and say, well, this mimics this or this mimics that. It's kind of a combination of some weird mix of a bunch of different things. A tech bubble, 40s fiscal spending, 70s inflation from the real estate market, but it's not as pronounced. It's got a little bit of everything. The Kobayashi letter says, here's the real question, what's going to happen to housing prices? 2020, rates go down to 3%, housing prices skyrocket on strong demand. In 2022, rates go up to 2001 high, housing prices skyrocket on low supply. In 2024, rates go down in the largest first cut since 2008, and housing prices do what? Question mark. Historically speaking, lower rates mean higher housing prices due to stronger demand. Can housing prices really make another push higher after rising 50% in 5 years? I want to correct him here. Historically speaking, lower rates do not mean higher housing prices due to stronger demand. That is false. False. 100% false. At the end of these cycles, what you're going to see, and this is when the cycle breaks and we built too many homes, lower rates will not result in higher housing prices. In 2008, 2009, 2010, we had lower rates and lower housing pricing. That also occurred in the 1920s and 30s. That also occurs whenever you break the housing market. You will also see at the end, if it's not a big, deleveraging bubble, if we built too many homes, we could also see lower interest rates and house prices go sideways, like 1990, 1991, and some of those other timeframes that are very similar to what I'm describing here. So it does not mean that every single time you get lower rates, it means higher housing prices. That is false. What it means is when lower rates cannot stimulate demand for housing, that we actually went through the cycle. We're going through a recession. Global observable oil inventories. Look at this, guys. We're way down here. Foolish. That is inventories continuing to decline. Silver over in Shanghai, ripping it, 3.37%, 31.19, looking pretty good for Shanghai, silver in Shanghai. That's USD silver, and Shanghai was 2.51. We've got Grady here. Uranium miners did 580% in its baby bull move, just getting started. It's still extremely cheap against the S&P 500. So what we've got here is a potential big move to the upside. The real fireworks will start above the black line when capital will start to realize that uranium will outperform general equities going forward. It's coming. Do not get bearish on uranium. Stay bullish, my friends. Stay bullish. Tavi says, the uninversion of the yield curve was arguably the most important market development following the Fed's recent policy decision. We saw a notable decline in the percentage of yield curve inversions within the U.S. Treasury curve, now down 67%. In my opinion, The yield curve is set to steepen sharply from here, as it typically does after major inversions. And that's when we get those slowdown recessions. Each time you get these big, sharp steepenings. What's it going to look like this time? I don't know. No one knows. But that's generally when a slowdown does occur. I've got silver ripping and looks great long term with many long term patterns breaking. I hope you're ready for this silver bull market. And there's the big long term pattern, the uptrend channel going back somewhere towards the upper end of that uptrend channel, and the big cup and handle that we are breaking here in the shorter term. This is the Fed cuts 50 basis points with home prices at all time highs and rising 6.5% per year. There we are ripping here for the average composite 20, and they're lowering rates, probably going to cause a big housing market bubble. Just like the year 2001 and 2 and 3 and 4 and 5. Now, are they going to go to the extent of handing out free money? I don't know. That I don't know. That's what caused the problem in the last housing market crash, is all that money lending. And that's what I've got for today, guys. Kind of a shorter one, but thumb up for the content, subscribe to the channel, subscribe to the website, and that's all I've got for today. So we'll catch you next time. This is Finding Value.